Welcome to Breaking News to Trading Moves the Debate. You know, when you learn to drive a vehicle, the rules are pretty clear. You obey the speed limit, stay in your lane, and, well, rely on your own reflexes.
Right, just the standard rules of the road.
Exactly. And if you crash into a tree, the failure is entirely yours. You know, you got distracted by the radio, or maybe you panicked at a yellow light.
Yeah, it is user error, like a total failure of the operator behind the wheel. You cannot blame the highway for your own bad driving.
Right. But imagine stepping onto a track where the other vehicles operate at the speed of light. The lanes change direction without warning, and the traffic signals are controlled by an unseen competitor who knows your route before you even start the engine.
That sounds like a nightmare.
It is. Suddenly, blaming the driver for crashing feels totally inadequate.
Work against the everyday participant. The infrastructure itself is designed to make you fail.
And that exact dynamic is what we are arguing about right now. We are evaluating the primary forces driving retail investor outcomes in the stock market. We are looking at academic literature, market data, and regulatory reports to answer one core question. Do retail investors routinely underperform the broader market averages due to their own predictable behavioral biases, or are they victims of an uneven playing field dominated by institutional mechanics and structural exploitation?
It is a massive question.
It really is. Now, I argue that retail outcomes are dictated by internal cognitive errors. It is, emotional reactions and attention-driven trading that lead to self-inflicted losses.
And I argue that pointing the finger entirely at retail psychology lets Wall Street off the hook. Market mechanics, algorithmic execution, and waning regulatory oversight create an environment that systematically extracts capital from retail participants.
Okay, so let us look at the behavioral mechanisms first, because we really have to understand what the baseline is here. We are taught that the market generally functions as an efficient market hypothesis weighing machine.
Right, the classic academic theory.
Exactly. To put that in plain English, it means the market digests all available news, calculates value, and spits out a logical price. It is rational.
In theory.
In theory, yes. But retail investors consistently fail to capture this value because they fall prey to well-documented cognitive errors. The most destructive of these is the disposition effect.
Ah, the psychological pain of taking a loss.
You hit the nail on the head. Think about the highly relatable feeling of opening up your brokerage app on your phone. You see a sea of red.
We have all been there.
We have. But instead of doing the rational thing, cutting your losses on a bad trade, you stubbornly refuse to sell because it would force you to admit defeat. You tell yourself, it will bounce back tomorrow.
Right, you just hold on and hope.
Exactly. Meanwhile, the moment one of your stocks goes up 10%, you sell it immediately just to secure that quick emotional dopamine hit of a gain.
Even if it had room to run.
Right. The mechanism here is clear. Retail traders actively cultivate portfolios filled with declining assets while weeding out their winners prematurely.
Look, that psychological pain is a documented phenomenon. I will not argue that. But it is an incomplete explanation for widespread portfolio destruction.
Well, the data demonstrates the severity of these cognitive errors, particularly when we look at attention-based buying. Retail investors face a search problem. There are thousands of equities available, right? And rather than conducting rigorous financial analysis, they buy whatever captures their attention on the news or social feeds. If we review historical data analyzing over 4,000 discount brokerage accounts over 5 years, the results are stark.
What did the numbers look like?
Trades placed on days with abnormal volume yielded an annualized return of negative 19.45%.
Oh, wow. That is rough.
It is. Compare that to a positive 1.2% return for trades placed on days with normal volume. Retail traders consistently underperform because they act on emotion and noise rather than fundamentals.
I hear you. But focusing purely on retail psychology ignores the mechanical realities of the modern financial ecosystem.
How so?
Well, while behavioral biases certainly exist, the ecosystem actively preys on them through high-frequency trading and micro-manipulation. The market is not a perfectly neutral weighing machine.
Okay.
Pointing to behavioral finance as the sole culprit is a distraction from structural extraction.
But how exactly does the structure extract capital if the investor makes a voluntary, uncoerced choice to log in and purchase a stock?
Because the environment is engineered to exploit the order flow of those voluntary choices. Consider the academic research analyzing 31 prosecuted manipulation cases on the Nasdaq Stockholm Exchange between 2018 and 2023.
Okay, the Swedish data.
Exactly. This literature proved that true market manipulation directly degrades market quality. It is not just an excuse used by bad traders. Manipulation widens the bid-ask spread, the gap between what buyers are willing to pay and sellers are willing to accept.
Right, the spread.
When that spread widens, it forces rational, information-seeking investors to exit the market altogether. The ecosystem is a structured environment where sophisticated actors maintain distinct informational and speed advantages over the everyday participant.
To understand why retail traders lose money, though, we must first examine the modern engine of retail volume. We have to look at social media forums.
Like the message boards?
Exactly. Platforms like Wall Street Bets operate as a behavioral trap that exacerbates the absolute worst impulses of retail investors.
It is certainly a central hub of activity, but categorizing it merely as a trap places the blame entirely on the user.
Well, the data from a global platform of 25 million users supports the behavioral trap thesis completely. Retail traders consistently flock to stocks ranking in the top 20% of abnormal social media mentions.
Because they are chasing the hype.
Right, and we can see exactly how this damages their returns by looking at the open-close trading imbalance. Let me explain how that works.
Sure.
A retail trader reads a hyped-up post at midnight. They submit a market buy order. When the opening bell rings at 9:30 a.m., a flood of these orders executes all at once, driving the price up to an irrational peak.
The morning spike.
Exactly. By the time the market closes at 4 p.m., the hype has died down, the smart money has exited, and the price crashes. These traders herd into assets exactly when price bubbles are peaking.
They get caught holding the bag.
They are buying the absolute top of the market driven by online hysteria, leading to pronounced underperformance across domestic equities, cryptocurrencies, foreign exchange, and commodities.
You are absolutely right that the herding behavior is real. I am not denying the open-close imbalance, but you are completely omitting what happens on the other side of those trades.
What do you mean?
Who exactly is selling them those shares at 9:30 a.m.?
I see why you think that, but let me give you a different perspective. Think of social media as a magnifying glass for our worst habits. It accelerates the rate at which investors act on the fear of missing out.
FOMO is definitely a factor.
Is it really the market's fault if an individual willingly buys a stock purely because they saw a cash tag on a message board? They are choosing to abandon rational analysis in favor of meme-driven momentum.
I come at it from a different way. Social media is not just a magnifying glass. It functions as chum in the water for institutional algorithms.
Chum?
Yes. The literature indicates that sophisticated actors anticipate these attention-grabbing events. Let's make this totally clear. Retail traders think they are hunting for alpha on message boards, but they are actually the prey being hunted by Wall Street's algorithms.
That implies a level of coordinated targeting, though.
It is not coordination. It is just superior technology. Institutions possess the technology to monitor the exact same forums, identify the rising retail momentum overnight, and execute trades in milliseconds.
Okay.
They provide liquidity at premium prices to the retail herd at that 9:30 a.m. bell. They are deliberately extracting value by selling into the retail buying pressure before the inevitable mean reversion occurred.
But providing liquidity is a core neutral market function. If retail investors demand shares of a company going viral online, market makers and institutional actors supply those shares to keep the market moving.
Sure, but at what cost to the retail buyer?
The fact that the retail investor bought at a premium is a consequence of their own late entry into a momentum trade, not some malicious algorithmic attack.
It is not a neutral function when the structural mechanisms are designed to front-run the retail demand. I mean, if institutional actors are extracting value from retail order flow, we must examine the specific mechanical tools they use to do so.
You mean the algorithms?
Yes. This brings us directly to high-frequency trading, or HFT, and the constant reality of market manipulation. Retail traders on forums often complain about manipulation for a valid reason. The market structure allows for it.
The cries of manipulation are usually just a coping mechanism for poor trading decisions.
Let us look at how the mechanics actually work. The literature notes that HFT operates on the absolute edges of SEC Rule 10b-5.
And for those unaware, 10b-5 is the primary rule regulating manipulative and deceptive practices.
Exactly. By generating and routing orders at extraordinary speeds, literally using fiber optic cables and co-locating their servers physically next to the stock exchange's servers, these algorithms can engage in legalized front-running.
It is a speed advantage, certainly.
A massive one. They detect the incoming retail order flow, raise ahead of it, purchase the available shares, and sell them back to the retail investor a fraction of a second later at a slightly higher price.
Right, capturing the spread.
Even if an algorithm only steals 1 single cent on the bid-ask spread across millions of trades, it creates an insurmountable structural barrier for the everyday investor.
I'm not convinced by that line of reasoning because retail traders cry manipulation simply because they misread macroeconomic events.
How is front-running a macroeconomic event?
I am saying that, as noted in trading community discussions, a general market rebound after a disruptive global event is not manipulation. It is the market correctly adjusting to new information.
Well, sure.
Furthermore, paying a 1-cent premium on a spread is microscopic noise for a long-term investor. If you are buying a company based on its cash flow projections over the next decade, a 1-cent execution delay is mathematically irrelevant.
But the volume...
It absolutely cannot be blamed when a retail portfolio drops by 20% over a year.
I'm sorry, but I just don't buy that. Let me tell you why. Re-emphasizing the Nasdaq Stockholm data is critical here.
Okay, let's hear it.
True market manipulation is not just an excuse used by sore losers. It is an empirically proven phenomenon. The data shows actors execute large, profitable trades that artificially alter liquidity and pricing.
Altering it temporarily, maybe?
When a manipulator enters the market, the bid-ask spread widens across the board. This directly harms the retail participant regardless of their time horizon. You might think 1 cent does not matter, but over a lifetime of investing, constantly buying at artificially inflated peaks and selling at algorithmic troughs acts as a permanent structural tax on every transaction.
But the academic literature you referenced regarding the Nasdaq Stockholm Exchange also mentions that trade-based manipulation is incredibly difficult to detect.
It is complex, yes.
It involves simply buying and selling without spreading false rumors or engaging in obvious fraud. If it is that difficult for advanced regulators to parse out, it is highly likely that retail traders on message boards are entirely misidentifying standard market volatility as malicious manipulation.
The difficulty of detection does not negate its existence. It merely highlights the inadequacy of the regulatory framework designed to police it.
Which brings us to a really natural transition here. If these algorithms are allegedly front-running retail trades at the speed of light, the obvious question is, where is the highway patrol?
Exactly.
We have to ask how the regulatory referee is policing the ecosystem right now.
Well, if we look at the data, the Highway Patrol has put away the radar guns. Regulatory oversight is currently waning, leaving retail investors more exposed than before.
You are looking at the recent enforcement numbers?
Yes. In fiscal year 2025, the SEC brought only 313 standalone enforcement actions. That is a 10-year low. It represents a 27% drop from 2024 and a 38% drop from 2023.
The raw volume of cases does not necessarily measure the effectiveness of the enforcement. Quality matters over quantity.
Volume measures the presence of a deterrent. If you know you will not get a speeding ticket, you will drive faster.
Fair point.
Under Chairman Paul Atkins, the weekly average of cases dropped to 3.61. Under the previous leadership, that number was 11.44 cases per week. We are looking at steep declines in both investment advisor and broker-dealer cases.
Okay.
By reducing the frequency of enforcement actions, the regulatory body is removing a vital deterrent against everyday institutional infractions.
That's a compelling point, though I would frame it differently. Think of a police force that stops handing out minor parking tickets so they can focus entirely on catching bank robbers.
But the parking tickets maintain general order.
Policing micro-infractions bogs down the SEC with administrative paperwork. Chairman Atkins promised to return the SEC to its core mission.
Which is what in this context?
By focusing on actual, flagrant fraud, such as prosecuting self-proclaimed online luminaries who are actively defrauding investors through Facebook groups and Discord servers. The SEC is protecting market integrity without stifling the broader market with administrative noise.
That's a persuasive argument, but have you considered what happens when the gatekeepers are no longer scrutinized? By drastically lowering the volume of broker-dealer enforcement actions, dropping from 61 to 43 in a single year, the regulatory body signals a tolerance for boundary-pushing behavior.
How so?
Think about the mechanics we just outlined. Broker-dealers are the exact entities facilitating the complex order routing and algorithmic execution. They manage the actual plumbing of the market.
Okay, the plumbing.
When enforcement drops in that specific category, it signals a tolerance for the exact kind of systemic, structural boundary pushing that harms retail investors in the aggregate.
I disagree. It signals a transition toward prosecuting intent rather than administrative errors. If an investment advisor fails to file a routine piece of paperwork on time, penalizing them does not protect a retail investor from a 20% portfolio drop.
Sure, paperwork is one thing.
Prosecuting a fraudulent stock promoter who uses social media to trigger a pump-and-dump scheme does protect them. The current SEC approach aligns perfectly with the behavioral argument. It targets the bad actors who exploit the psychological weaknesses of the retail herd rather than harassing institutions for technicalities.
But the structural extraction does not require a fraudulent stock promoter. It requires a slightly wider spread, an algorithmic speed advantage, and a broker-dealer willing to prioritize institutional order flow over retail execution quality.
Right.
None of that looks like a traditional pump and dump. It looks like standard plumbing. When the SEC averages fewer than 4 cases a week, the institutions operating the plumbing of the market understand that the referee has put away the whistle.
The referee has merely stopped blowing the whistle for minor infractions that do not impact the core weighing machine of the market. Look, at the end of the day, retail investors have to take a hard look in the mirror.
Meaning?
If a retail trader avoids the behavioral traps, if they ignore the social media noise, maintain a diversified portfolio, and execute trades based on rigorous financial analysis, the structural mechanics you are describing will not destroy their wealth.
That assumes the structural mechanics only target the irrational. The NASDAQ Stockholm analysis proved that manipulation degrades market quality for everyone.
Even the long-term holders?
Yes. When liquidity dries up and spreads widen due to manipulative trading, the rational, information-seeking investor suffers alongside the irrational meme stock trader. The ecosystem extracts its toll regardless of the user's psychological discipline.
Well, we have thoroughly mapped the mechanics of this issue from the way human emotion drives buying patterns to the complex plumbing of order routing. Let us summarize our positions in light of the data discussed.
Sounds good.
I maintain that retail investors must take responsibility for their own psychology. The primary force driving their outcomes is their own decision-making process. By recognizing the disposition effect, avoiding attention-based buying fueled by social media, and utilizing their structural advantage of not having institutional sizing restrictions, retail investors can succeed.
It is a fair perspective.
The data clearly shows that those who buy calmly on days of normal volume vastly outperform those who chase abnormal, attention-driven volume.
And while I acknowledge that psychology matters and behavioral errors occur, ignoring the mechanics of algorithmic trading, the reality of market manipulation, and the evolving regulatory landscape leaves an investor naive to the true rules of the exchange.
Right.
A 10-year low in SEC enforcement actions and the empirical reality of high-frequency trading advantages demonstrate that the market is a structured environment designed to extract capital from the less sophisticated participants.
The interplay between human behavior and market structure remains a complex, ongoing debate. We clearly disagree on which force exerts the primary gravitational pull on a retail portfolio.
We do. And there is far more nuance to explore in the underlying academic literature and market data regarding order routing, regulatory history, and cognitive finance. We have really only scratched the surface of how algorithms interact with human emotion.
Exactly. As we step back and look at the broader picture, we return to the track. Are you crashing because you took your eyes off the road to look at your phone?
Or are you crashing because the road itself was quietly tilted against you while you were driving? We leave you, the listener, to form your own conclusion about whether your portfolio's performance is governed more by your own decisions or by the mechanics of the market itself.